VICI Properties today has been under $28. It is one that I have also been adding. We can see a double buy rating and a strong buy from Quant. Today we are going to do a deep dive as to why this is such a strong, undervalued, must-buy REIT. We're also going to take a look at this company, looking at their dividend safety, which doesn't look too great, borderline safe score of 50, so we'll do a deep analysis. We can see a yield now touching around 6%, and we'll look towards both the insider ownership as well as institutions to see if they've been buying or selling in the more recent period. We're also going to take a look at their latest investor presentation that they did just release 2 weeks ago, as well as look at their latest earnings to see how they continue to surpass expectations, and importantly understand their growth on a top line revenue as well as a bottom line net income basis, and very importantly does tie through to that dividend safety is their debt levels, the health of the company, their cash versus their total debt, and probably most importantly, we will run them through the valuation model. We want to get to our intrinsic value. What is our acceptable buy? What is that investor margin of safety that I personally have been adding to? And we'll also look to see how much of an upside are Wall Street predicting over the next 12 months, given we have a triple buy rating. Now, the first thing that we do want to point out was that they did release their earnings at the beginning of this month, and as we can see, their revenue and their net income did surpass analyst expectations. Revenue alone was up 8.4% year on year, as we can see, surpassing the analyst estimates. On top of that, what is more important than earnings per share is the adjusted funds from operation, the AFFO, and this grew double digits, 10.3%, as we can see. Very, very strong. So very good earnings from them in just the more recent quarter. And when we do take a look overall, typical with the real estate investment industry, they are down around 8% just over the last 12 months. When we look year to date though, down double digit, negative 12%. And for those that do hope those interest rate cuts do come very soon, we do expect the performance of this REIT to improve significantly. Over the last 5 years, though, it is up around 24%. We can see as well, if you were reinvesting those dividends, they would be up slightly higher. And we do note it is towards their 52-week low. Yield, as we mentioned, touching 6%. And as we can see here, the P to FFO around 11.08. Now, very importantly, with REITs, you do want to see around 5 to 10% increase on their top line year on year. What we actually see here, 19 million reported in 2014, 3.6 billion in their more recent annual report. And as we can see on a graphical basis as well, over the longer term, a very nice increase to their top line revenue, something you always want to see in any company, whether it's a REIT or not, in those that you buy. In terms of their bottom line net income, well, 43 million in 2017, 2.5 billion in their latest annual report. So again, similar to their top line revenue, their bottom line has also been increasing right the way that we want to. In fact, a lot better. And as we just mentioned in the more recent quarter, also surpassing all the analyst targets. Very important then, this is a REIT, 6% dividend yield quarter on quarter is paid out. You want to ensure they can continue to pay that. 4.4, in fact, as we see here, so 400 million in 2015. Around 485 million in their latest quarter. And when we do take a look over the longer term, it is very inconsistent. So quarter on quarter, year on year, it does change quite significantly. But remember, on this alone, it doesn't really mean much. We do need to take a look at their total debt. And what we can see, around 4.8 billion of total debt in 2017, around 17.6 in that latest quarter. Similar to other balances, it has been increasing over the longer term, something that you could argue is typical with REITs. They do take on a fair amount of debt so they can continue to grow. So we will take a look at this in more detail, especially given the fact that we do see a borderline safe dividend score. Always very important, we do like to see how they've performed in terms of FFO versus the analyst targets. What we can see here, in fact, over the last 4 quarters, they have beaten twice of 4, so a 50% track record. They do tend to beat or miss very marginally, 8 cents in the last quarter, 9 they beat in the previous. And forward looking, what we do note is they do anticipate to decrease by around 5%, although the next quarter up double digit. So as we can see, very, very inconsistent quarter on quarter. And when you do take a look at it in terms of the funds from operations estimate, in 2024, forward P to FFO around 11, 2025 around 10.6, and more importantly, we will take a look to compare how this is against others in the exact same industry and sector. So here we go to the valuation grade, the first one. They do get a B+. When we take a look now, very important to understand for REITs, we don't tend to look at the PE, which is what we do for other companies. We focus on the price to AFFO, the adjusted funds from operation. Now they get a B-. We do see here 12.56. It is in fact lower than the sector median of 14.23 by around 12%. So you are getting a discount if you do believe in comparison this is a very strong company against the others. We will take a look at them shortly. Overall though, when you do take a look at other valuation metrics, depending on what type of investor you are, which one you want to use, we can see overall they do get a B+. We then move on to the growth grade. Nice to note they get an A+. When we break this down, historically the adjusted funds from operation over the last 5 years has increased by 8.5%. When we compare that to the sector median, 2.2%, so a lot better. And when we just take a look at the year-on-year increase, 11.4, a lot better than the sector median, as well as a forward-looking basis around 7%, with others around 2%. So already we can see the quality that this is against others in the sector. So maybe you could argue it does warrant a higher essential AFFO to price. In fact, this is one that is lower than the sector. We can also see other metrics here as well. We will cover a lot of these, but the dividend growth rate over the last 5 years has been around 7.8%. As we can see, not much growth from others in the same industry. We then take a look at their profitability grade. They do get an A+, very positive. Lots of the metrics we will cover very shortly, as we tend to do. That if you want to look at their payout ratio, 75%, and that is something, as we'll look in the investor presentation, that they do want to maintain year on year. Sector median pretty much around that at 74%, and on a trailing 12-month basis, pretty much in line with anticipated over the next year. Again, a lot of these we will cover, but if you do want to take a look, it is all there on the screen, so you can include it in your own essential analysis. Now, in terms of just concluding this part of the process, what we can see is a triple buy rating, a strong buy in fact from Quant, B+ on valuation, A+ on both growth and profitability. Now, as we mentioned, there are others in the similar industry, what we would categorize as other specialized REITs: Iron Mountain Incorporation, Gaming and Leisure Properties, Lamar Advertising, EPR, and Outfront Media. Now, over the last year, this includes reinvesting those quarterly dividends. VICI Properties, the worst performing, down 5%. When we expand this over the last 5 years, however, we do note they are up there right in the middle of some of those competitors in the sector, 61.25%. Whether or not that is good for you as an investor, that is completely up to you, but a lot of people do like REITs. They do tend to pay nice high yields, as we can see for VICI Properties, around 6%. Although do bear in mind their past performance, whether you think this is good or not, isn't something that we use to determine their future performance. Now, in terms of the insider ownership, does sit at 0.25%. In fact, 0 instances of insider selling. We do know 1 incident of insider buying, around $86,000, although you would have to go to around Q1 of 2024. And when we do take a look at who these are and also the date, 14th of March, director pretty much bought around 3,000 shares, a little bit higher than the current trading price, and as we can see for that total amount. Now, personally, I believe insider buying, it is a bullish signal. It does mean that they believe the share price will go up, but you could argue it is a relatively trivial amount, so maybe not one to incorporate into your investment thesis. We then move on to look at the same, but for the institutions, very high institutional ownership, 98%, 2.4 billion worth of sales by the institutions over the last 12 months, with a lot more buying for just over, in fact, 4.03 billion over the same period. On top of that, in the more recent quarter, Q1, we do see a lot more buying than selling. The same can be pretty much said over the more recent quarters as well. But remember, always do your own due diligence. Don't copy what these institutions or investors, insiders do. Now, before we move on, we want to let you know we've just released our latest free weekly article. We do run through some of the best recession-proof stocks historically to consider for the portfolio. If you want access to this or any others, all completely free, do click on that pinned comment below. You can start reading straight away. We also take a look at 20 undervalued dividend stocks, as well as how to find undervalued stocks, the websites and resources we use within our own analysis. Now, they did just release an investor presentation a few weeks ago. Few things that we want to point out. This may be more applicable for those that are newer to VICI Properties. Over the longer term, as we can see, they do continue to increase their EBITDA, the earnings before the interest, tax, depreciation, amortization, year on year, as we can see here with the numbers. So they are growing. It isn't one that is stagnant. There are lots of REITs that we do cover where, for example, the dividend growth doesn't seem to be that much. The sales growth also seems to slow down. But as we can see, year on year, a lot of things are going on, which we can take a look at as well. First thing that we wanted to point out, they do have 13 tenants. Now, in terms of their largest tenants, around 40 or 39% to be exact is made up of Caesars. In fact, you could say 74%, which is a large chunk, is made up of Caesars and MGM Resorts, which is in Las Vegas. And as we can see, that is quite a large amount. But in terms of the WALT, so this stands for the weighted average lease term, it is quite significant. On average, in fact, over the 13 tenants, 41.5 years, so there's quite a long time, and in total they do have around 93 properties. When we take a look at a few points, just really to point out for those that are quite bearish on this company, in 2020 when there was a recession, when a lot of these places had to be shut down, they still received 100% rent collection rate, whereas others, REITs, are very similar, received, as we can see, 70 to 99%, so not as good as VICI Properties. Remaining lease term, as we can see, is around 42 years, whereas others 8 to 14, so they are holding for quite a significant number of time, which is always very positive, and they also have that long-term CPI protected rent roll as well. On top of that, when we do look at the increases to that same store rent, 1.7% is a lot better than others as well at 0.4% in the industry. And when we do take a look at something that we will cover, their dividend growth, as we in fact mentioned earlier, has been increasing at a much better rate than others. If you want to compare it to ADC, Agree Realty, as well as others, EPRT, Four Corners Property, and we have GLPI, it is significantly better, 7.9%. We even have Realty Income, 2.7%. Always something just to consider with companies, not just the dividend rate, but at the rate that they do tend to increase it year on year. And for those that do want to see the geographical perspectives of where these companies, where these properties are held, as we can see here, it is quite geographically diverse, all across the US as well as Canada as well. Finally, the last thing that we wanted to point out with Las Vegas is it isn't somewhere that is suddenly going to go quiet. It is a big destination for a lot of different things. There's sports as well as concerts and a lot of gaming as well. As we can see, gross gaming record 8.9 billion, in fact an all-time annual record. So I would say this is very bullish for the future of VICI Properties, and if you can buy it at a very strong price, then it could be one that does pay dividends in the future. Dividend safety score then, 50, borderline safe. Let's talk about this as we go through. Dividend yield of 5.94%, so very close to a 6%. Market cap 29.5 billion, a large cap company. Now we do see just a couple of weeks ago that their dividend safety was reaffirmed. Now what this means, it does suggest that there is a moderate risk of a dividend cut over a full economic cycle, and we can touch upon that. In terms of the dividends and the comparative data, as we know, this company was listed in 2017, so we don't have any of the recessionary data to take a look at. One thing that we have touched upon is the nice increases to their dividend, 6.4% in September last year, 10% over the last 5 years. That is very strong double-digit growth, especially for a company that has only been increasing those dividends for the last 5 years. Now, for those that are new, we do always take a quick look at dividend yield theory, which states a company is undervalued when the current yield sits above the 5-year average. 5.93 versus 5.04, so that is our first undervaluation signal. Forward P to AFFO 12.3, below the 5-year rolling of 14.8, another undervaluation signal, and a third one as well. It is lower than the real estate sector of 13.8, but as always, we don't look at any of these models in isolation, and we will conclude towards the end. Adjusted funds from operations, so this is one thing that does correlate to that dividend safety, as we touched upon, below 75%, not just for hotel REITs, but something that VICI management do target pretty much consistently around that year on year, 73 expected in 2024, so no worries so far. We then move on to the adjusted funds from operation per share growth. Now, one thing I didn't mention is that we don't tend to look at the free cash flow for REITs. It is a lot more volatile, whereas for other companies, this becomes our main focus. Over the longer term, it has been increasing consistently. 2024, we do expect this trend to continue. Now, in terms of the percentages, what we can see here over the last few years, in fact, 3 of the last 4 years, they have returned 11% of AFFO per share growth. 2024 anticipated around 4%. And when we take a look at the actual sales growth, their top line from 2020 across, very strong double-digit growth, although we do see a slowdown on a trailing 12-month basis to around 18%. Now, numerically, we did just cover this earlier, just a different format to look at. But one thing that I do reiterate on this channel, very important to understand, yes, we love it when companies do share buybacks. What this means is essentially you get a larger portion of the company. With REITs, it's the complete opposite. They do dilute your position. Some, as we can see, like VICI Properties, at a fairly rapid rate. Now, do remember, this is a reason, and it is because they don't retain a lot of that internally generated cash flow. They do pay a vast majority out as dividends, something just to bear in mind, and maybe something we can analyze when we do look at our margin of safety. ROIC now typically 10% or more, for REITs 3 to 5%, just to give us faith management are able to effectively allocate their capital. VICI Properties very strong, 8% in the more recent year. We then look at the operating margin, again very healthy, very high year on year, 92% as well in the more recent period. And finally, something that does correlate to that essential dividend safety that we do need to consider is the net debt to EBITDA. Now, this is the earnings before the interest, tax, depreciation, amortization. And what we're looking for is below 3.5 as the preference for hotel REITs. Now, remember, these are the number of years it would take the company to pay off all of that debt net of cash on hand. What we can see, 5.86 in the more recent year. It is a lot higher than 3.5. The only positive to note that it is coming down in 2024 to 5.42 or anticipated to, so just something to bear in mind. Their debt levels are very high, it is increasing, although we do note this trend has been decreasing over the last few years. Just something to keep an eye on though, in my opinion, moving forward. Let's jump into the evaluation. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. First one, multiple valuation model. We have companies in a similar sector and size. Their P to AFFO multiple, their average, and we also have the P to AFFO of VICI to give us an intrinsic value of $33. So we do have our first undervaluation signal. Just bear in mind, we don't look at any of these models in isolation. We then move on to the dividend discount model. We have that growth rate there, as we mentioned, very nice and high, just under 8% over the last few years. Forward looking, a lot more conservative at 4%. We do notice a very large undervaluation signal. $28 currently market value, around $44 based on this intrinsic price. We then move on to the DCF model, where we have the essential free cash flows year on year, average growth rate. Forward looking, very, very realistic and very conservative. With the discount rate, we get the present value of future free cash flows and terminal value. Add together the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we have our another undervaluation signal. Intrinsic value here is just the average of these three models, and it does in today's episode arrive at $37. Don't forget, you can grab a copy of this valuation model to get to the intrinsic value as well as the acceptable buy price by clicking on the pinned comment below, running your own numbers through as well as companies on your watch list and those essentially in your portfolio. So a 10% margin of safety we do execute if it meets our three criteria. Remember, a wide moat, strong financial metrics, and good forward-looking data. We then keep going till it's near the current trading price, and in today's episode we pretty much see it at a 25% margin of safety. Now yes, it is a REIT, it won't do massively well in a high interest rate environment, but ultimately we do believe that interest rates will get started to come down, starting to get cut by the Fed in their latest meetings. We do anticipate at least one cut by the end of this year, and as those cuts do start to come in place, we do hope that REITs, along with VICI Properties, will start to take off as they have been hammered over the more recent period. In terms of Wall Street and their price expectation, well, a little bit lower than our intrinsic value, but they have a price target of $35. They see upside of 25%, and as we said at the beginning of the episode, a triple buy rating, a strong buy from Quant. Now this is one that under $28, we do like it quite a lot. We have been adding more to our position. Dollar cost averaging in, as if it does continue to drop, we will continue to add more. Over the longer term though, we do see this going back over to $30 and reaching a new all-time high, although this could take 1, 2, maybe 3 years. So again, it does depend how comfortable you are, your own investment thesis and your own due diligence. As always though, we would like to hear your thoughts, whether or not this is one you're adding, maybe you're waiting for a larger drop, or maybe you already have a full position, or in fact maybe it's one you just don't want to touch because it is a REIT. As always, if you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.